cutting rates was basically a way of bailing out the government, nothing else. The Federal Reserve started panicking in June when they decided to slow down the pace of normalization of the balance sheet because bond yields were soaring and the level of government debt was absolutely out of control. Deficit spending was out of control, and global demand for treasuries was declining. So that was the first sign of panicking. The second sign of panicking came in September when they decided, against every indication of what they're supposed to be looking at, to cut rates by 50 basis points in an economy that, according to Chairman Powell, had no evidence at all of signs of recession or risks of even a downturn. So cutting rates was basically a way of bailing out the government, nothing else. So there was no problem in availability of credit, no problem allegedly in the GDP figures, no problem in the unemployment figures, no signs of recession and no signs of a downturn. 50 basis points cut. Who do you believe?
And this really shows, the great and growing aversion to U.S. Treasury debt. Foreign holdings of U.S. Treasury debt as a percentage of total have been, trending, lower now. And this is from 33% to 22%.
This chart is extremely important because what you hear all the time in the United States, you hear it all the time, and you're also fighting the good fight. There's no problem with the U.S. deficit because the U.S. debt will always be absorbed by international investors and will always be supported, and it's the lowest risk asset. Therefore, the U.S. can issue all the debt that it wants. Well, that's not true. That is not true. Number one, it has an economic limit. The amount of GDP generated by every unit of public debt has declined by more than half in 10 years. So for every dollar of new public debt, you get less than 50 cents of GDP. Number two is the fiscal limit. You raise taxes, you don't get enough receipts. Certainly, furthermore, the interest expense in the budget soars even with low rates to now the second largest item in the budget. And the third is international demand. The US dollar is the world reserve currency. The US dollar is treasuries, obviously. So when you and I were in the hedge fund world, you remember when foreign demand of treasuries relative to net issuances were higher than 100%. So every time that there was any sign of not crisis, but some sort of uncertainty in markets, bond investors globally, central banks globally would pile on US treasuries. I remember in 2008 and 2007, when it was 150% foreign demand for treasuries relative to net issuances. Well, in the last figure, it is less than 30%. Less than 30%. So it's not just that the US government is issuing more and more and more debt, it's that the world demands less and less treasuries as a reserve, as something that is going to be a safe haven, as something that is going to give them a cushion, that is going to be a safe asset to own. Central banks all over the world, from China, India, Oman, so many others, are reducing their holdings of treasuries relative to their asset base and increasing their positions in gold. What does that mean? It means that there's a diminishing confidence in the solvency of the US government, and that can be exceedingly dangerous in the future if the government, the next administration, ignores the warning signs. A lot of people say, oh my gosh, this is going to trigger a debt crisis, and they think of a debt crisis in a sort of Greek way, Greek drama type of way. It's not going to happen like that. But what it leads is to stagnation and persistent inflation. But the United States can get to 150, 170% debt to GDP. Absolutely it can. But if you want to follow France, you're going to become France. Increasing taxes is not a tool to reduce public debt. It's a tool to justify higher public debt. The United States, with its economic imbalances and its fiscal imbalances, is going to be virtually impossible to get into a sort of called debt deflation Japanese style. It will get into the debt, but with inflation, because it is issuing a currency that's whose global demand is diminishing.
Like what purchasing power of a dollar, when you debase it by 78%, that's going to be inflationary.
You and I remember when central banks were actually monetary institutions that paid attention to monetary aggregates. Now we have monetary institutions that talk about anything except monetary aggregates. Higher for longer lasted less than 18 months, which is the biggest joke I've heard in my life. Okay, he went on TV and all the media and said, we have to be used to higher for longer. 12 months later, lower for longer. What? You know? So this is showing why the credibility at the end of the day, the central bank's job is not just to be the provider of liquidity of last resort. It's also to provide confidence in the currency that the government issues. So when you do these things and you flip-flop and you start saying things like inflation is due to supply chain disruptions disappear and inflation continues to creep, obviously you're making a dishonest message that is doing a very negative favor to the credibility of the institution and the credibility, therefore, of the currency. Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.